Hey everyone, good evening, or I guess good morning or afternoon, or wherever you're watching from. But thanks for joining me for another great live stream. As always, we're talking about the latest real estate news, gossip, trends, interest rates, all the good stuff. Thanks for hanging out with me. I'm Joe Pareca. This is my channel. Welcome. And for those of you that are returning back, thanks for coming back. Appreciate you guys giving me some of your time during your busy schedule. So we have a great stream lined up today. We have actually a really interesting article. I know we kind of touched on this a couple weeks ago with the fires and insurance, but more information is coming out about how climate change is going to be a problem, specifically when we're talking about property values and housing and mortgages and all that stuff. So it was kind of interesting. The whole fire thing kind of spurred this conversation, but as I kind of dove into it, turns out that the whole climate change housing thing is nothing new, and I'm going to show you what I mean by that. Hey Dominic, what's going on, brother? Hope you're doing good. Thanks for hanging out. Hey, Mom's in the chat. Hey Mom, how you doing? Thanks for hanging out. So we're gonna I have an article, and then I have the same article in like a video form, which we might watch, we might not watch. And then also too, I want to talk about interest rates a little bit, because we are getting just a smidgen of relief from interest rates. And they're coming down just a touch. Don't get too excited. It's not going to make any meaningful difference, but hey, some relief is good relief, right? So we will get started and we'll jump into it. Of course, at any time, if you guys have any questions, comments, any thoughts, please go ahead, pop them in the chat. Honestly, the best part about live streaming and the reason that I like live streaming more than producing long form recorded content is because I get to interact directly with you guys in real time. So if you guys have any questions or comments at any time, please go ahead, pop them in the chat. I really like hearing from you guys. And it can be about the article we're talking about. It could be about something completely different. Or it could be a question about real estate that you have that you just you want to ask someone that's not ChatGPT or Google, and you actually want a real person to consider the question. So at any time, the chat is open, the comments are there. Please put anything you got in there for me. And lastly, before we jump into the article, you guys do me a huge favor, hit the like button. It's somewhere right down here on your screen. Hit that thumbs up, give the stream a like, and of course, if you haven't subscribed, please subscribe to the channel. It's completely free, doesn't cost you anything. And it really, really helps out me, and it helps out my channel. So let's get into it. All right, let's do this screen. So we're going to be talking today about this CNBC article that's pretty wild. And of course, I saw the headline, and we got to click on it. Now, as you guys know, I'm a little bit of a headline hunter in the reverse sense. So I like to find kind of clickbaity, grabby headlines, and then reverse engineer them and explain why this is all kind of, a joke and clickbait. We saw that on the last article I did about how California homeowners lost like $350,000 in home value. And that headline was so misleading. I had to talk about it. This headline is not quite as misleading. It's probably rooted in a little bit more truth, but it hasn't happened yet. So we'll see if it pans out. And again, we're talking about all this stuff mostly because this is also repercussions of the LA fires. Of course, as you guys, most of you probably know, I am very close to the LA fires. Thankfully, I'm not directly affected. My property's not affected. I'm about 15, 20 miles away from the Altadena fire. And as just really quick, obviously we have a very fast news cycle in America today. 24/7 news is always flying around. There's always something new to talk about, right? And of course, the news wants to keep it moving so that they always have the next headline to come. But one thing we need to remember is that the devastation in Altadena and the Pacific Palisades, it's only beginning, right? There's huge, mammoth efforts to get both of those regions cleaned up. So please just remember that even though it's not in the news, it's still affecting people every day, just like the storms in North Carolina, right? So if you can help, if you can contribute in any way, please consider donating to various nonprofits to help some of our fellow Americans in need all across the country, because who knows where the next natural disaster is going to hit, and it could affect you. And when that affects you, well, chances are you're probably going to want some help from your fellow Americans. So just keep that in mind as we talk about this stuff, that this stuff is very real, and it's very, very real right now for some people in particular. Okay, let's get into it. U.S. housing market could lose nearly $1.5 trillion in value due to rising costs of climate change. Now, before we get further, climate change. Okay, so I don't care what your thoughts on climate change are. I don't care what your thoughts on global warming are. I don't particularly want to hear it. But be that as it may, we do need to talk about how the climate is changing. And certainly we have enough data now to know that we are getting more severe storms, and we're getting them more often. And that could come in firestorms like we saw in Pasadena and Pacific Palisades, or it could come in the form of hurricanes, flooding, hail, cold, winter storms, freezing storms, things like that. So we're not here to debate whether or not what the cause of climate change is or what your thoughts are on it. We are talking simply about how the change in severe weather events is affecting housing and how it could further affect housing as we see how these weather events shake out. All right, so this article, February 19th, so just about a week ago, from CNBC, Diana Olick. So by 2055, 84% of all U.S. homes may see some drop in value, totaling $1.47 trillion in losses, according to analysis by climate risk firm First Street. So already, it's kind of interesting in the very first point, they're telling you right off the rip, okay, so the housing market could lose 1.5 trillion, but potentially not until 2055. Okay, still not a good thing, but this is not immediate. So already the headline is starting to lose a little bit of its cachet, if you will. 84% of all U.S. homes may see some drop in value. May see some drop. Okay, so now we're using newspeak now, where it's like, well, this could happen, maybe, and if it does happen, this might happen. Okay, still, I see where they're going with this, and it's good to talk about. It's good to think about, but don't get too alarmed. Totaling 1.47 trillion in losses. Okay, well, let's see. Roughly a dozen counties in Texas, Florida, and Louisiana could see home values cut in half, according to the report. That in half is quite substantial. I don't know if we'll see half. Do I believe that the areas in Texas, Florida, and Louisiana could see home price devaluation because of weather-related events? Absolutely. Louisiana, Mississippi, Florida, I mean, it's like what they do is they just get pounded by hurricanes. It's beautiful when there isn't a hurricane, but they're right for that. So I certainly could see that those areas are going to face some difficulties with insurance premiums, and therefore could have some issues with mortgages, and therefore could have some issues with property values, because those areas will become more expensive to just even consider owning a home in. In the next 5 years, at least 20% of U.S. homes will be devalued by the effects of climate change, says Dave Burt, founder of Delta Terra Capital, an investment research and consulting firm. And here's Burt Dave Burt right here. And he's the one, and his firm says at least 20% of U.S. homes are going to be devalued in the next 5 years. Okay, so that's a little bit more of a real claim, of a real hypothesis. He's put a recent timeline on it. He's given a number of at least 20%. He doesn't know how much they'll be devalued, but some will be devalued, which I absolutely believe is going to be true. So I'm with him on that. So this is the video that, depending on the time, we might take a look at it. It's kind of the article here is basically the text form of the video. The video is still kind of interesting though, so we may take a look at it depending on how much time we got. I want to make this a little bit bigger because it's probably very difficult to read for you guys. There we go. That's probably a little bit easier. Okay. It is still too soon to fully calculate the cost of the Los Angeles wildfires, but one thing is clear: the cost of insurance will go up, and that will affect not just the value of LA real estate, but of real estate across the nation. And again, we talked about this on the last stream. If you guys didn't watch the fire and insurance stream, we talked about this, that the reason LA fires are going to raise the cost of insurance for everyone is because those insurance providers are going to pass the costs on to all insurance policyholders, not just those in a specific given area, which, I guess makes sense, right? They're going to spread out the losses and they're going to try to make it as palatable as possible on their customers. And if they just passed on the cost of these natural disasters to those people in Los Angeles County, Southern California, or in California as a whole, then, those costs would be significantly higher. And the same goes for any other natural disaster, right? It's not just the LA fires that are getting passed along to everybody in the nation, but it's the North Carolina hurricane. It's the freezing, rainstorm. It's the freezing winter storms in Texas that cause damage. It's the hailstorms in Oklahoma and the Midwest that cause damage. It's all of these things. It's the flooding, it's the hurricane that happen everywhere. So whenever there's an extreme weather event in the United States, you might think, oh, well, it doesn't really affect me. That's in Florida. I am in South Dakota, not my problem. Well, actually, it is your problem because number one, your fellow countrymen are in need, so it's your problem. And number two, on top of that, your insurance is going to go up because of that disaster. So keep that in mind when we're talking about things. The losses from those wildfires may seem unimaginable now, and they absolutely do, but they were actually already part of a calculation that climate risk experts have been modeling recently as they attempt to measure the effects of climate change on home values. By 2055, 84% of all US homes may see some drop in value, totaling a 1.47 trillion in losses, according to an analysis by First Street, a climate risk firm. Now, in all transparency and disclosures, I don't know anything about First Street. I don't know who they are. I don't know what their deal is. They're a climate risk firm. I don't know anything about them. One thing that we've learned is that, take the information, understand the information, but verify the information, right? Trust, but verify. And so obviously we're talking about some big numbers and some very big claims. So, it would be smart before you make any decisions based on this to obviously look up First Street. I don't know much about them. Climate change is no longer a theoretical concern. It is a measurable force reshaping real estate markets and regional economies across the United States, said Jeremy Porter, head of climate implications research at First Street. Yeah, again, I don't think he's wrong. Like I said earlier, I don't really care what your thoughts on climate change or global warming are. The fact of the matter is we are having more extreme weather events more often, and that is going to shape not only just real estate, but also local businesses and regions and areas. So all these areas are going to get affected in different ways at different times. Okay. So according to the report, insurance is expected to grow by a national average of 25% over the next 30 years, with 14% of that due to current underpricing of risk, and the additional 11% due to increasing climate risk over that time period. Now, one thing I want to talk about is 14% of that due to current underpricing of risk. So that's been one of the problems with our the way that insurance works in the United States. And I'll speak specifically to California just because that's my state. I know a little bit more about it, a little bit more familiar with it. So in California, we have the Insurance Commission, and the Insurance Commission basically said, hey, insurance providers, you can only raise insurance so much. We need to make sure that that your customers and our residents in California, aren't the victim of insurance rates that just keep getting jacked up and they keep going up and up and up. And this was in the past. So historically, the Insurance Commission basically kind of put more or less a cap on how much insurance rates could go up. Now you think, hey, that's great, right? Like that's awesome. They're looking out for the little guy. They're trying to make sure that we don't get gouged by these giant corporations. But what happens when you artificially keep the price low of something? Usually there's a very big rebounding effect. And that's what we're going to see right now. So not only are insurance companies having to increase the cost of premiums because of increased natural disasters, both in frequency and severity, but they're also having to catch up with all the previous times where they couldn't raise rates as much as they needed to. And that's why we're going to see some insanely huge insurance increases over the next several years. And of course, what the article says is about 25% over the next 3 decades, which obviously is substantial. We already know, insurance providers have already told us, like, get ready. Your insurance premiums are going to go up. And they are getting much more picky with what they're covering. We saw this with the LA fires, them canceling insurance coverage and policies just months before these fires. And it's, obviously it's pretty alarming. So the insurance commission, as with most things government does, the insurance commission had, it was kind of a good plan. It was the right idea. On paper, it seemed good, but in practice, it led to some undesired side effects, and we're facing them now. We're paying for them now. Hey, David, how's it going, buddy? Hope you're having a good week and a great evening. Thanks for hanging out. Appreciate you. All right. So the property value impact on average is only about -3% nationally, but there are some areas that are expected to lose a significant amount of their value. Roughly a dozen counties in Texas, Florida, and Louisiana could see home values cut in half, according to the report. Now, the interesting part here is you don't see anything about California. I mean, the tagline of this article was, the California wildfires, too big, so much damage, we can't even fathom it, right? And then it's interesting because it's talking about how, well, we're not expected to see a huge drop in real estate values, but Texas, Florida, and Louisiana are. And I'll tell you, I think my hypothesis on this is simply the fact that Texas, Florida, and Louisiana are just not as desirable places to live as opposed to California. And again, we can debate whether or not you think that's true. Some people, you couldn't pay them to live in California, which is fine. That's, your prerogative. But at the end of the day, there's a very, very clear statistical data that shows that more people want to live in California. How do we know this? Look at the average sale price of a California home. It's over $850,000 in comparison to the average residential sale price of the average home in the United States, which is about $450,000, $460,000. So the average home in California is almost twice as much as the average home in the United States. Thus, one could say that on average, people want to live in California twice as badly as everywhere else in the United States. So I think that desirability is one of the reasons that leaves California off of this list that includes Texas, Florida, and Louisiana. I just don't think people are as eager to move to those states. And in the past, Texas and Florida have been desirable, but Texas is having some real issues, mostly with property taxes going up increasingly, insanely fast. Florida has issues with insurance, which is why they're in this list, and so does Louisiana. Florida used to be very, very popular. It had very favorable tax laws, income tax, things like that. It's very business friendly, but even that is now being counteracted by the cost of real estate and the cost of insurance. And poor Louisiana, nothing against Louisiana, beautiful people in Louisiana, but just not a very desirable place to live when it comes to the states. And that, in conjunction with the fact that it seems like every year they flood or get a hurricane, I could certainly see them losing significant property value. Dave Burt, founder of Delta Terra Capital, is also calculating climate risk to real estate. Delta Terra is an investment research and consulting firm that provides institutional investors and others with tools to measure and manage financial risk related to climate change, according to its website. In the next 5 years, at least 20% of U.S. homes will be devalued in some way by the effects of climate change, Burt said. In the past, insurers have not increased prices because of these increasing weather events, he said. That's all falling apart now because of the fragility of the system and some of the insurance market failures that we've seen in just the last few years. So kind of what we were talking about, how historically they didn't really keep up with the pricing that they should have. And now they got to raise the rates. And obviously that causes some stress on homeowners and potential home buyers. But Burt was one of the few to predict the risks in the subprime mortgage market nearly 2 decades ago, and he made a lot of money betting against those loans. Okay, I'm going to take a quick aside here. I love stuff like this. Burt was one of the few to predict the risks of the subprime mortgage market. You know what's funny is it seems like ever since 2008 occurred and passed, now every real estate pundit is touted as being one of the few that saw the writing on the wall. Oh, they were one of the few that saw the subprime crisis. Oh, the Oracle of Wall Street saw the subprime crisis. Well, where the hell were you in 2005, 6, and 7? No, nobody was sounding the alarm at that time. But now all of a sudden it sounds like, oh, of course, everybody saw it coming. So I always get a chuckle when they say, oh, yeah, this person who's so, they really know what they're talking about. And here's why. Oh, they called the subprime mortgage meltdown. Well, oh, where were they back in those days? Anyways, I digress. Bert says he sees a similar pattern emerging with climate change. Growing climate risk forces the insurance industry to reprice higher, home values will drop because when the cost of owning a home rises, its value falls, he said. The correction, he said, will be severe. And now, I don't know about this. This is one thing where I kind of disagree a little bit on this, and I'll give you a little story to prove my point. It says growing climate risk forces the insurance industry to reprice higher. Home values will drop because as the cost of owning a home rises, its value falls, he said. This just simply isn't true from what we've seen in the past few years. I mean, think about it, guys. The cost of home ownership has skyrocketed. This is nothing new. I'm not breaking news to you guys. You all on the stream know this, unless you've been living under a rock. And even though the cost of owning a home has increased incredibly, what has that done to home values? It's increased them. Home values have not dropped, even though home ownership has become more unaffordable. And it hasn't become a little unaffordable. It's become very, very unaffordable over a very short amount of time for reasons that I'm not going to get into on this stream. That's a whole nother stream, but it has to do with lack of building and the 2008 financial crisis and the repercussions that we're still feeling, blah, 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 blah. So with that being said, I don't particularly subscribe to this idea that, if home values will drop because the cost of owning a home will rise and therefore its value will fall. And the anecdotal story I have to kind of just demonstrate that is look at the vacant lot in the Pacific Palisades, right? I mean, we all heard that story. The very first vacant lot in Pacific Palisades went up for sale for like $1 million, and the real estate agent his phone wouldn't stop going off because so many people wanted to buy it. And eventually it sold. It sold relatively quickly. It sold for over the asking price. Obviously that lot sold for less than the home that burned down that was on the lot was worth. But very clearly, there are still people that are willing to pay large sums of money for a plot of land in a desirable area. Fire risk be damned, right? Obviously, there's a huge fire risk there. Everything just burned down. And that fire risk is low now because the area just burned. But in 10, 15, 20, 30 years, that fire risk is going to be back up again. So, it's just one of those things where I get what he's saying. And I think the theory, yes, I get the theory. And maybe that theory would hold fast if we had the inventory in other areas to sell these people to make the homes more affordable. But I don't see the blanket statement, with, home's value will drop because the cost of home owning a home rises. There still is that demand there. There still is that group of people out there that have the money and they want to live where they want to live. And maybe that's not Louisiana, maybe that's not Florida, but maybe it is markets like Southern California. So my take on that. All right, we got a couple comments coming in. Hey, Innovative. Hey, by the way, Innovative, I saw your comment on my previous live stream. Thank you for that suggestion. And I was hoping you'd be in the stream tonight because I want to let you know I actually have 7 videos in the can. I'm launching a new channel very soon. I just got hooked up with a new video editor. And that new channel, I'm going to be putting out 1 long form video a week. And I'm going to be doing a live stream per week. So stay tuned. I'll let you know when the new channel is up. You can follow me there. What do you got for me tonight, Innovative? Let's see. Look at Canada's housing market. Homes can stay unaffordable for a long time. Exactly. Case in point, Innovative. And I love this. I love when people go, the market there has to be a correction. The values have to keep going up. Home prices have to come down. Interest rates have to come down. Market doesn't got to do anything. The market doesn't have to do anything you say or want it to do. The market's going to do what the market does based on events that take place, right? And that's why I don't agree with this statement. Hey, Cackleberry, thanks for hanging out. Hope you're having a great week. Hi, Joe. The difference with the fires in CA is that they are not natural disasters. Oh, this is a good point. Most of them are started from human activity and get so bad due to gross mismanagement. Yeah, this is a good point. Now, there's all sorts of schools of thought on how California manages their open space, their wildland. I know that there were some politicians that were like, just rake it up, just clean it up, just dispose of it. It's much easier said than done. However, with that being said, California has been very lax on forestry management, mostly due to environmental concerns. And you make a good point, because we did not take the proper precautions to protect homes in high fire areas. So while it is a natural disaster, it's a natural disaster that potentially could be avoided, but could definitely potentially be better protected against. And we're starting to see some of this take place in flood prone areas. So now in areas that have hurricanes and flooding, they have now come out with these movable barriers that can be set up very quickly. They can go around your house or your building, your government building. And usually they're about a 5 or 6 foot tall wall, and they clamp to the ground and they clamp to each other, and they actually make a watertight barrier. So you could actually put about a 5 or 6 foot wall around a building, a house. Now, this technology is still on the new side. It does work. It's been put in place in some areas. It's not really convenient on a consumer level, but those are the types of things that we're going to need to do. And when it comes to the fires in California, we certainly could have built our homes a slightly different way. We could have been a little bit better with fire defense systems, sprinklers, fire retardant, brush clearing, all of those things. So, Cackleberry, you are correct. It's the California fires should be treated a little bit differently than an actual, act of God, such as a tornado or a hurricane or fierce rain that leads to flooding, where those things you can't control very much. You can't control if it rains or not. You can't control if a twister touches down in your town or not, or if a hurricane blows through. But you can have a little bit of say in how your house fares during a fire. So yeah, that's a good point. Good point. Okay. We think that those 20% of markets could be down 30% over the next 5 years in value, which is very similar to the 2007 to 2012 Great Recession experience. No, I politely disagree, sir. I don't think, I don't know these 20% of markets and having them be down 30% over the next 5 years in value. That's a very big percentage in a very large amount of time, especially where we're at a time where you guys saw last. I'm not even going to look for the graphic, but you all saw probably the inventory graphic that we've put up. There's only like 3 states in the entire nation that have more inventory right now than they did pre-pandemic. That inventory is coming back, and certainly it could change in 5 years, but to see 20% of markets down 30% over the next 5 years and to somehow equate that to the 2007 to the 2012 Great Recession, I just don't believe it. I don't believe that that's going to be the case. The factors that led to the 2007 to 2012 Great Recession are insanely, completely 180 degrees different than what we're talking about now. I'm not saying climate change won't affect housing values. That's not what I'm saying. But I think that this is a very aggressive estimation of what is probably going to happen. Okay. And Bert is not alone. Senator Sheldon Whitehouse, Democrat from Rhode Island, warned of the risk of Treasury Secretary Scott Bessent's confirmation hearing. The most immediate danger of a major economic collapse is going to come through the insurance industry, Whitehouse said in January. We're seeing it already. The fires in LA are making it worse out in California, but it's occurring nationwide where you can't get mortgages. You can't sell properties at value. While experts have been warning of this for several years now, their predictions are coming true faster than previously expected. Growing climate-related disasters risk has accelerated much more rapidly, said Ben Keyes, a professor of real estate and finance at University of Pennsylvania's Wharton School. Ultimately, assets are going to have to find a new equilibrium in order to clear out the market. Exactly. They will find a new equilibrium. I just am in the camp that I don't think that equilibrium is going to be 30% less than what it is now. Could it be? Absolutely. I could be wrong. And maybe some of those people out there that have struggled to afford a home, Maybe they'll, be optimistic, cautiously optimistic about what property values could do. But if property values go down by 30%, but insurance costs go up by 25 or 30%, how much are you really saving in your affordability? You're saving some, but not a ton. So something to think about. Add foreclosures to that. After Hurricane Sandy in 2012, foreclosures in affected areas rose by 46%. And after 2008 floods in Ames, Iowa, foreclosures jumped 144%, according to First Street. This here, I think is nonsense. And I'm going to tell you why. Both of these times, 2012 and 2008, especially 2008, we were in the throes and the depths of one of the greatest economic recessions this nation's ever seen. I don't think that the foreclosures jumping 144% could be completely attributed to the floods in Iowa, and probably more attributed to the great financial crisis. Now, did these floods probably contribute to that? Absolutely. But I don't think this is good data to rely upon, because there were other big economic factors happening at that time. Hey, Maddie B, thanks for hanging out. Good to see you again. The higher house prices in California also reflect very high permitting costs, over $100K per unit. Yep, and lengthy time to build. Yeah, you're absolutely right. And in fact, $100K per unit sounds about right, because typically about 20 to 25% of a cost of a new build is caught up in what we call red tape and kind of like bureaucratic things. So that's permitting. It's also environmental surveys. It's different things that have to do with local zoning laws, studies, research, things like that. CA is not builder friendly versus other states, so inventory is limited by design. Yeah, you're absolutely correct. CA is not builder friendly. And not only is it not builder friendly, but there's just not a whole lot of desirable areas to build, because we're based on suburban sprawl. So you've hit the nail on the head. Not only is California land is expensive, which isn't builder friendly, permitting is expensive, which is not builder friendly. There's a ton of environmental red tape and studies that need to take place, which is not builder friendly. And labor is not cheap here. So again, it's all kind of stacked against California home builders. You're exactly right, Maddie. The mortgage market is not unaware of these rising risks. Fannie Mae declined an interview request for the story, but CNBC spoke with their chief climate officer, Tim Judge, in 2023 on the same subject, as mortgage giant was beginning to study climate risk and underwriting. The amount of climate change is not necessarily always priced into the market, and consumers aren't really aware of what that's going to do to insurance premiums going forward, Judge said. So this is back in 23. The big guy at Fannie Mae, that's what they do, is they buy mortgages. That's what they do. He's basically saying in 2023, we are not accounting all the time for climate change risk and how that could affect things. And we don't know what's going to happen with insurance when it comes to climate change. So they kind of knew about this. 2 years later, Fannie Mae still doesn't account for climate risk in its underwriting at the property level. The decision that Fannie and Freddie make are guiding the mortgage market away from pricing climate risk directly, Key said. In the meantime, Delta Terra's Burt is betting again. What we're doing is we're helping clients integrate our understanding of the roadmap going forward into hedging strategies, Burt said. That can be either avoiding the most at-risk securities. It can also be hedging with mortgage credit derivatives. He's talking about how he's helping these corporate investors and corporate landlords navigate these risks of climate change. So whatever, don't really care about them. Rising insurance costs will be the main factor in home price declines, but not the only one. Some communities might increase taxes to pay for resilience measures. Maintenance and energy costs may also go up. This is a good point. Some communities might say, hey, we're flood prone. We are going to build better levees, better flood control channels. We're going to build another dam or reservoir. And in order to do that, we're going to levy a parcel tax, increase in sales tax, whatever it may be. And that obviously is going to increase the cost of home ownership and lower home affordability. Despite all of this, the Trump administration on Friday ordered FEMA staff to immediately stop implementation of the federal flood risk management standard. This is a standard that ensures that public buildings, including schools, as well as bridges, roads, utilities, and other infrastructure that are damaged in a flood will be rebuilt in a way that would make them less vulnerable to future flooding. So, there you have it with this article, guys. I mean, it's a little bit scary, the fact that 1.5 trillion in value, but this is all projections. We don't know what's going to happen with climate change. We don't know what's going to happen with weather. Predicting short-term weather is very difficult. Predicting long-term weather is very difficult. Predicting what the climate will do is very, very difficult. But the fact remains, we know that right now there's a lot of data that shows that we've had an increase in both the severity and frequency of natural disasters and major storms and things like that. So it can't be ignored. And we'll just have to see what happens with the insurance situation and how that shakes out. And before we go to the really quick interest rate update that I want to do, I'm going to share this over. And this is from YouTube. And I want you guys to take a look at this. I just searched housing climate change risk in the search bar here. And 1 year ago, CNBC did a story about mortgage industry to face climate risk before lending. 3 years ago, this same reporter, that's the lady that wrote this article, she said off-the-grid homes are coming as risk rise from climate change. 2 years ago, what is the riskiest region in the U.S. as climate changes, right? 1 year ago, 4 years ago, climate change could cause the next housing crash 4 years ago. So this is not anything new. I mean, we've been talking about this for a while. Obviously, we've been talking about seaside homes and sea level rise. So none of this is new at all. And it's just very interesting to see that now it's kind of coming to a head. It's coming to the surface now. And it seemed like the fires were kind of the catalyst. The LA fires were kind of the catalyst to this talk, because quite frankly, I don't know if we've ever had a natural disaster before that is consumed as many resources as the LA fires did. I mean, I think at last count, it was something like roughly $160 billion worth of damage and losses, which is quite frankly incomprehensible. So I just wanted to show you guys this as well, just to kind of demonstrate that this is nothing new. We've been talking about climate change and how it could affect housing and house prices for a long time now. All right, so let's flip over and get maybe to a little bit better news. Let's see here. Will mortgage rates drop before spring home buying season? Today's rates as of February 24th. This is a couple days ago, but this will kind of add to it. So you can see right down here at the bottom, it's kind of small, but 30-year fixed rates at 6.88%. It's a little bit better. Not just but a week or two ago, it was actually at 6.957%, hovering there. So we're getting a little bit better. If you're looking at a 15-year fix, it's 6.22. And a jumbo is not quite as good as the rate. It's a 6.95. So let's talk about interest rates. When the Federal Reserve began cutting interest rates last year, many hoped it would make homeownership more affordable. Yeah, right. Yet mortgage rates have stayed high, and they're unlikely to drop significantly over the next few months. For a 30-year fixed mortgage, the average rate you'll pay is 6.94% today, unchanged since 1 week ago. The average rate for a 15-year fixed mortgage is 6.26%, which is an increase of 0.02% since last week. Now, when we talked about interest rates, we kind of figured that in 2025, the Fed wasn't going to do a ton. The Fed wasn't really going to be super aggressive. Inflation was doing better. It ticked back up a little bit. And now, of course, we've got the Trump tariffs that are going to probably take effect here in the next week or two, I think is what I read. And we'll see what that does. There's a lot of concern around that, which is why interest rates are actually lowering a little bit. There's concern that there could be some recessionary signs from the tariffs, and investors have been, obviously trying to hedge their bet and figure out what they need to do. And when the economy gets a little bit dicey or isn't or is looking like it might not be as hot or churning along, investors turn to mortgages. And when investors turn to mortgages, when more investors buy more mortgages, it creates a lower interest rate because there's a bigger demand for people buying mortgages, investors buying mortgages. And when they do that, they try to entice people to sell them their mortgages by giving a lower rate. So basically they're trying to undercut each other so they can buy more mortgages when the economy looks uncertain. The Fed has paused interest rate reductions. With fewer cuts projected in 2025, markets are concerned that President Trump's economic policies could cause inflation to reheat and keep upward pressure on borrowing costs, which is absolutely true. If mortgage rates do manage to stabilize gradually and inventory increases, there could be more opportunities for new buyers. But experts aren't projecting any major changes in the housing market anytime soon. Mortgage rates need to get down to the 5.5% range or lower to really kickstart housing demand, said Alex Thomas, a senior research analyst at Johns Burns Research Consulting. It's long been thought that 5.5 is kind of the magic number. 5.5 is like, oh, if we can get it down to 5.5, these people are going to go bananas. And yeah, it seems to be true. And we know that based on just some surveys that were conducted over the last couple of years, basically saying, at what rate would you give up your 2.9%? Would you give up 2.9% to buy your forever home at 6.5%? No. Would you give it up to buy 6%? No. Would you give it up at 5.5%? Oh yeah, you know what? Actually, I think we would, with the equity and all this stuff. Yeah, 5.5%. We would take that loan. Okay, great. So we do know that 5.5% seems to be the kind of the magic number. But quite honestly, I think if we got anywhere close to even 6.25 or 6.0, it would really start to loosen up. And if we got to 5.99, it would almost be as good as 5.5. But just not the case. So I don't think we need to get all the way to 5.55. Certainly that would help. But even just to 6% would be a huge help. But again, when interest rates go down, what happens to prices, guys? Prices go up, typically speaking. Okay, we're going to go through this. Current mortgage rate trends. Mortgage rates hit record lows of under 3% during the pandemic after the Fed dropped interest rates to stimulate demand. After inflation surged in 2022, the Fed kicked off a series of interest rate hikes, which indirectly drove up mortgage rates. We all know this. Even after the Fed pivoted back to modestly reducing rates in 2024, mortgage rates have remained around 7%. So here we can see, this was kind of a cool graph. So you can see where all the times were good. We're going to only really pay attention to the orange line because that's a 30-year fix. That's the mortgage of America. That's what everybody gets. So you can see rock bottom. Look at this back in, January of 2021, 2.95%. We were cruising along 2.93, 3.1, 3.25, right? And then all of a sudden they were like, whoa, inflation, and bingo, starts to go up. 3.9, 4.9. In a month it went up a whole percent, and it almost went up another 0.5%. This was when I bought my house. I bought my house at 5.25%. And it just kept going up and up and up from there. And so until it hit a high of about 7.95%. Craziness. And it's leveled back down over the last few months, right around 7%. One thing I want to show you guys is when you are looking at rates, if you punch in rates into Google, or if you're getting ready to buy a home, just a tip for you guys. Okay. This rate that you see here, ignore it. Ignore all of this stuff. All of this. If you go to like Rocket Mortgage, and Rocket's like, we can give you whatever rate. It's all a teaser rate. Notice at least it's a little bit better. They go, oh yeah, we can give you 5.88%. You're like, 5.88%? This is amazing. But you have to pay 1.6 points. So you're going to have to pay each point. It's broken down into, it's a certain percent, right? It's a percent of the loan price. So basically you have to pay money up front. You have to pay money up front to get this rate, right? So just be aware of that. So you can see this one's 6.61%, much higher. This is 0 points. Now 6.61% for a 30-year fixed is quite good, but this is going to require 20% down with amazing credit, non-jumbo loan, so on and so forth. So when you guys see those interest rates advertised, those are teaser rates. Those are probably not what you're going to get. You need to do some research, do some digging. But the good news is we are getting just a little bit of relief when it comes to that. All right, guys. So we're at 44 minutes today. Today's gonna be a little bit shorter stream, but I do appreciate you guys hanging out. I appreciate you guys giving me some of your time, some of your very valuable. We will be back again next Wednesday, same time, same place. We'll be talking about more good real estate news. As always, if you guys have any specific topics you want me to cover, please let me know. You can leave it as a comment on this video. You can also email me. Or like I said, you just leave a comment on any one of the videos. I'll see it. And I'm always looking forward to hearing what you guys want to discuss and chat about and learn about. So if you guys have any topic suggestions as we move forward, please don't hesitate to let me know. I think that's everything for today. Thanks again. Hope you guys are having a wonderful week. I hope the rest of your week is excellent. Thanks again for giving me some of your very, very valuable time. Have a great Wednesday evening, and I'll see y'all later.